Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist.
Hey Tony, how are you?
Yeah, very good. Evan, today I wanted to talk to you about the oil sector and what's happening with the oil price. There's been a lot going on.
There's been a lot going on. So obviously I've been away for a couple of weeks, and there has been a pretty big change from what we look at it and what you need to look at. It is really a good way of looking at almost pure economics, which is supply and demand. And OPEC is a very interesting beast. The 15 nations that are inside of it realistically come down to probably three, being Saudi Arabia, Iran and Iraq.
Yep.
Saudi Arabia being a third of that whole total production, so they matter. The other one is Russia. Russia is actually a non-OPEC nation. A lot of people believe that it is actually part of it, but it is a non-binding part of OPEC. They do have a lot of influence and a lot of sway. The interesting thing about what's happening in the oil price is that this is the first time in basically 3.5 decades that coordinated cuts have actually been able to hold for longer than about 6 months. So it's the longest process of actually having supply freezes from OPEC. It's almost 2 years. It has worked, which is quite impressive considering that, again, you've got places like Venezuela and Mexico that tend to break because they're so heavily tied to oil. So let's have a look at what that means. It's the Russians that are quite interesting. And the reason for that is that economically, they're feeling a bit of pressure. We know that the Europeans are putting some economic pressure on them. You've seen the Americans put pressure on them politically and also economically. There's been issues around visas and blah, blah, blah. So with the oil price having now moved to basically a 3.5 year high in Brent and about the same in WTI, they need to extract value. Now, organically, their overall oil reserves are actually declining very, very slowly, but they are declining. And it makes sense for them to start saying, right, the fact that inventories in OPEC has fallen to below GFC levels, the fact that inventories in the States are also starting to fall, they have the ability to increase supply, although that it will push the price down a bit, and you've seen that quite dramatically in the last sort of couple of weeks. There will be a period where it will take time to fill those inventories back up. So they can actually therefore move back, as they're saying, to October 2016 levels with supply. They won't see a huge drop-off in price like they did in the past, where inventories are really strong. When you saw these production cuts, inventory basically picked up the slack and kept prices artificially low. That still will be there. You still need to probably put that as an issue with oil in general, is that the supply and demand curve has really been quite interesting because demand has actually been quite static over the last 5 years. So what does that mean for Australian producers? The original question.
Well, before we get into that, I was going to get into, we've got a situation here where, as you say, the Americans are putting pressure on the Russians. They're also putting pressure on the Iranians. So we're going to see quite a bit going on in terms of supply.
Yeah, you are.
As sanctions come into play.
Yep.
And then that's feasibly going to push prices up.
So the Iranian issue is the next side of this. So Iran is about third or fourth, depending on what's going on, in the OPEC nations. They make up around about 6% of global supply. So it's substantial. And you're right, if what's coming out of the White House really does ramp up, what's also coming out of Jerusalem is very interesting. Yeah. So what's happened in Syria, the political tensions are always there. They don't actually push the supply demand curve. Technically, they're pushing another lever, being geopolitics. But you're right, if Iran drops out, there's actually ability for Russia to suck up that supply changes as well. So it's an interesting market, always is. It's a lot of push-pull. The other thing we haven't spoken about is that over this time that OPEC's locked out, non-OPEC nations have picked up the slack. So that's the US, that's Canada, that's Norway, that's Brazil. To some extent, our gas productions have managed to benefit from that as well. They are the ones that actually do also benefit from here, is that every time they've seen the price get to about 70 US a barrel, you see the US all of a sudden tell you that rig utilization in places like in Texas and places like Puerto Rico and all those kind of areas, the Gulf just soak up supply. So this is why it's an interesting one. There will be personally upside pressures, as you said, from Iran, from the political side, but supply over the longer term is likely to cap oil at probably about $80 a barrel because it just becomes such a lucrative trade to get involved with, to suck up that value. All that capex that happened in the market between basically 2000 all the way up to 2013 is mothballing in some respects, and they do want to switch it on to actually extract value.
Do you think this is going to play into the hands of, say, BHP, who's got all the, it's not a big part of their portfolio, but they do have oil assets. They've got these big shale assets which are supposedly up for sale. So that might be beneficial to them.
They are. So they're non-core. So we know that BHP is flicking off their non-core shale assets. But getting back to BHP as an example, it is the largest gas provider and gas extractor in this country. It's bigger than Woodside. So it's a huge part of how you look at it. And again, moving away from just the oil story, if you still see the growth, economic story of the globe being there, that is the consumption of oil. It's the consumption of bulk commodity products, and that's where your Chinas of this world come into it. And you can still see that GDP is still moving quite nicely. There is a bit of convolution happening, and that's fine. There are signs that there is a little bit of some storms on the cloud, and that's why we always say diversification is always key. There will be up and downs in every market, and being diverse across that is there. Extracting growth is still done quite well for you. So BHP is always one to watch because it is the largest gas provider. It has been doing quite nicely anyway from the gas price and the oil price moving up, which improves the gas price as well. So it is there. It will be very interesting to see, however, how this plays out, whether or not the simple economics of supply and demand overruns and the supply pushes price down, or whether, as we've discussed, geopolitical issues take over.
Yeah, and then we've got other Australian stocks, as you say, Woodside, Santos, Beach, etc., and they're all
Oil Search
in this picture.
Yeah, Oil Search is probably the most interesting one. Oil Search is the most tied to the oil price. It has probably the purest play in Papua New Guinea, and it's a beautiful operator. So if you are looking at that kind of space and almost a barometer to what's going on, Oil Search is the one. But yeah, all the ones you listed, but if you do want to have a look purely almost at the oil price, it's them.
All right, we'll leave it there for today.
Thanks, Tony.
Thanks for joining us on The Economic View.